Olá, boa tarde. Vou começar em português só para fazer a introdução e depois a gente vai passar para inglês com a nossa convidada. A gente está aqui com... Bom, meu nome é Daniel Wicks, sou economista-chefe da Safra Assist, né? E estou aqui com a Mali Shivakal, que é a nossa economista lá do J. Safra Sarrazin, na Suíça, é economista para mercados emergentes, e a gente vai fazer esse painel aqui para mercados emergentes. Só dando uma breve introdução, a Mali é economista no Sarrazin desde 2022, tá? Mas antes disso ela passou 10 anos no FMI e antes do FMI também um tempo no Banco Central Europeu. Ela tem graduação e mestrado pela Universidade de Harvard, né? E é isso, vou começar aqui, então vou passar para inglês. E antes disso vai aparecer aqui o QR Code, para quem quiser pode me mandar aqui perguntas que a gente tenta encaixar no final. Mali, thank you so much for being here with us today.
Thank you very much.
Well, I know we're in a panel for emerging markets, but first of all, if you could just give us a little bit brief view on the U.S. There's so much going on there, the Fed, also the election. So before we go to emerging markets, if you could just share with us your view on the U.S. economy and perspectives.
Yeah, sure. I'll just be quite brief on this because I think it's been talked about already quite a lot during this conference. I think our central scenario is pretty much what I'll look over. You know, we are talking about 2025, right? So this is what we are looking at the end of next year is that rates will come down towards around 3.5%, which basically means that, you know, they are back to neutral in the US. And we are also a little bit hopeful that, you know, this is going to basically deliver what the Fed really wants, which is a soft landing. I mean, there is the possibility that there could be a recession, but even if there will be a recession, we think that it's going to be quite mild, given that, you know, the Fed seems to be quite willing to, you know, to lower rates fast enough to actually prop up the labor market.
Okay, so when we look at the emerging markets, you don't see problems coming from the US scenario, right?
Yeah, in that scenario, I think it's really good for emerging markets because basically, you know, high rates, actually emerging markets have been very resilient in the last couple of years with this, you know, very high rates in the US. And this hasn't been like this for quite some time, right? And actually emerging markets managed to grow and also did not, you know, beyond the frontier countries, which we had a lot of problems with, you know, credit defaults. But beyond, you know, the major emerging markets have been doing really well. You know, and this is basically because of the structural change. They borrow more in local currency now and less dependent on, you know, the outside market.
And do you think the U.S. elections, and depending who wins, could change the backdrop that we have for emerging markets?
Yeah, I think this is like, you know, the key question basically, because it could change the picture quite a lot. So I think if we all know that, you know, uncertainty is much higher if the Republicans actually take over the presidency. We do not really know if there is really going to be this tariff increase. And because, you know, we know that, I mean, we have the experience already of Trump being in power. So we know how he behaved, but which means that, you know, this is basically, nobody really knows if he's going to do what he said. And I think that is key because he has said a lot of things that is not very friendly to China, that is not very friendly to also Mexico, and also for, you know, also for Europe. Because I think this trade war is not going to be just on China, but he also, you know, is going to expand it to more like the rest of the world.
So let's turn to China, one of your expertise. When you were traveling to Brazil, the policymakers there had a lot of new measures, so I hope you had the time to take a look on the measures. So how do you see, you know, the current economic environment, the slowdown, and those new measures, should we, switch the plug to a more optimistic view, or should we still be more cautious on the China scenario?
Yeah, I think the measures that they introduced yesterday, basically, these are just monetary measures. Okay, they lower rates, the policy rates by 25, 30 basis point. If you think about it, the loan prime rate, which, basically this is the main borrowing rates that customers face, is still 3.5%, almost 3.5%. You're looking at inflation of almost pretty much zero. If you look at a producer's price, it's actually negative. So if you think about it, the real rate is actually still very high. It could be closer to like 5%. And in this environment, what I worry the most is actually the deflationary pressure that they face. So it's not only just about growth, because I think growth right now, they are trying to deliver it through external, demand, because there are now this exports of the capacity to the rest of the world is really driving the economy. But, domestic demand, consumption, housing market, everything is down. And also, it's the way that they have done the policy in the past few years. So they stopped this, since the global financial crisis, they have been pumping all this money into the real estate market. And then that lasted until 2021. Now that they realize that, there's already too many houses, and there's not enough, demand to actually buy all that, and all these developers are just too leveraged, and they're making too much money. They don't like it, so then they kind of killed it. But then, then they still, because it's a high savings economy, they directed all these resources into manufacturing instead. So since then we have, and also I think it coincided with the timing where, the China and US relations has changed. And that means that now they, channel all these resources into the strategic manufacturing industries and produce now too many of these goods, right, for the domestic market to absorb. So we are basically in the situation where in a lot of the markets in China right now, there is, just a lot of volume where prices are still falling. So it's not only housing, we are talking also about, other markets. And that is also being exported to the rest of the world. But I think, this deflation we have seen in the past. I think central banks are afraid the most of deflation because it's really hard to overcome it. So once you have the expectation that prices are going to fall, companies are not, basically earnings are not going to be doing well, then they start cutting costs. Then basically the labor market cannot do so well because then the employment opportunities is just not going to be there. Then it comes back to this vicious cycle of then prices falling more because then the demand is low. So I think they want to break this cycle, but then because of the behavior of the government that they have been so invested in supply side, basically, giving more resources to the supply side because they think that this is more productive instead of more of a demand side, measures. So I think we see a little bit of a good signal yesterday that, they're trying to show that, okay, they are, thinking about it, but then I think they need more. This is not enough because credit demand is not there. You can lower rates all you want. I think we have seen this before in other countries. And, we will have to wait and see whether they're going to get there or not.
When you say we need to see more, you mean fiscal, like a fiscal bazooka, or do you expect anything like this in the short term?
Yeah, a lot of this problem of low consumption is a bit structural, but it's a mix of being structurally high savings because you have a lot of these migrant workers. So out of around 1 billion labor force, you have about, let's say, 300 million being actually, moving from one place to another, being migrants. And a lot of these migrants, very few of them actually move the whole family. So most of them are, only one person in the city, the rest stay in the rural area, and then they don't consume basically because they need to send the money back. And all this consumption is basically being absorbed in the rural area where, there's not very high consumption, right? So I mean, this is the structural part. But then you have the cyclical part, which is basically, this very poor sentiment of the income outlook and employment outlook, which basically, if you are very uncertain, you don't know, if you're going to be laid off, there will be more jobs. I mean, this also coincided at the same time when they cracked down on a lot of the services industry, which has been actually the main job creation since, I guess, the last 10 years. So this was the last 2 years that has been bad. We're talking about internet, platform, financial services. So all these people are actually getting paid less now. They're getting their bonuses cut. So I mean, the outlook is just not very good, right? So you would rather save.
But do you think the government would go for something like a Bolsa Familia that we have here, like transfers to the population that could, incentive the consumption?
I mean, they need something like that, I think. I think my guess is that the probability of that happening is quite low. I think they will spend some more, but then I think they will try to spend more on like investment again, which, okay, it trickled down, but, it takes much slower time.
Okay, and about the house market in a specific, there's a structural story, but I think also kind of a cyclical because there's a confidence crisis now. Nobody wants to buy new homes because you don't know if it's going to be delivered to you. So there's do you think that the government can try to, I don't know, come up with a fund with public resources to buy new homes and try to, make the wheel turn again? Or no, the solution is going to be that you're going to just let the housing bubble deflate for itself, in the next years?
Yeah, I mean, that's one of the measures that they talked about yesterday, right? That the central bank is going to fund most of the amount that local government can borrow to turn this housing into like a public housing. But then I think local governments themselves, I think they're also in trouble because they do not have enough revenue at this point. And, and to load more debt onto their balance sheet, it's just not very, I guess, favorable for, I mean, if you are local governments, you're not going to do it unless it's like really cheap or you get highly subsidized or, I don't know, free money from the government, then you do it. I mean, at this point, I think it's still too expensive for them to actually get into this program and convert the unused housing.
Okay, so if I get you right, we can be a little bit more optimistic in the short term, but the structural story is still a bad story. So it's hard to be optimistic in the longer term since we have so many problems, as you said.
Yeah, I think it's quite hard because if you also look at the housing market, when in other countries, when they have a housing crisis, it usually takes like 6 to 7 years for prices to really, bottom out and then before it takes off again. I mean, this happens in, during a global financial crisis in Spain, in Ireland, you see the same kind of pattern. I mean, in China, we are in year 3, right? So there is still more to be absorbed, and there's still more to be actually like finished in terms of the unfinished building. And that is not happening because the developers are not getting the financing. And I don't see like the willingness from the government to really, support the developers to finish this. Because they actually, I mean, they can, right? They can actually just give them give them more like equity and then take over some of the projects and then just do it. But then this is quite difficult because in the end, it's a local government problem. It's a very decentralized country. So the federal or whatever, the central government would like to do it, but then they might not be able to.
And this structural weakness in the Chinese economy, how does it play out with the rest of the emerging markets? Because, I mean, well, it helped the disinflation process now because they're exporting disinflation, right? But, I mean, thinking about commodities and, you know, since Brazil it's a commodity producer, how do you think it's going to play out with the rest of the emerging markets?
Yeah, I think people have been surprised that they have been actually importing commodities in terms of metal, in terms of coal, and also like agri products in the last year, basically, in the last 12 months. The volume is still increasing. But it's not very clear exactly where, you know, there are some theories that are keeping this as a strategic inventory, because it's not everything goes into the inventory that you see in the data. So there must be something that is, you know, somewhere else. But there's also still some demand from the manufacturing side, right, where they are actually producing a lot of this renewables, which needs a lot of copper, maybe iron ore, a little bit less iron ore story, which I think matters for Brazil, seems to be connected more to the steel industry, which is, again, in the same story where you have very little domestic demand from the housing market. But, you know, the steel mills, they need to survive. So they still produce and then they export. And most of the exports actually end up in emerging markets. And I think some emerging markets already started, you know, trying to put, like in Brazil, you know, trying to put more on the import duties, preventing from, you know, this cheap kind of anti-dumping duties. But there are still some others that likely benefit from, you know, this cheaper steel.
And I don't know if you share my opinion, but you know, in the past when domestic prices and asset prices in China they've had swinged a lot in the past few months, and it didn't affect, you know, like the S&P, the Ibovespa here. Do you think that, you know, the stock markets in China had lost importance in the rest of the world? Because if you think about what, like in 2015, it helped like the flash crash in the S&P because China was going so bad. So, and nowadays we talk about China, but we don't see China affecting the rest of the world, the asset markets. Do you think it's true?
Yeah, I think on the stock market, I think it's true. And I think this is mostly because, I mean, part of it is also people expect that earnings are not going to be doing so well in the, you know, in the next 12 months, mainly because of this deflationary problem. Although they now have this, you know, new money to prop up the market. So this seems to be kind of a recurring events. Every few months when stock markets go down, then they try to come up with something in terms of the policy to prop it up. But then this turns out to not be sustainable, and then, you know, and then it goes down again. So I think the belief in the stock market is not very high at this point, even though it's very cheap. But I think there is still this, you know, macro story that is hanging over the market that makes it more difficult, I think, to recover.
Great. And also moving away from China and going to India. India has been in the spotlight lately, and we started to talk about China here in India here in Brazil. Many people calling India is the new China. How do you see the India scenario going forward?
India's growth is very different from how China has grown in the last, 20 years. Right? So India's story is more domestically driven. It has very little manufacturing capacity, and the manufacturing part hasn't really grown in the last 10 years. So the share of GDP still stay the same. I mean, we have heard a lot about the stories on iPhones, right? I think now 1 in 7 iPhones are now made in India. But that is also quite telling, because I think the government is trying to get more of this high-tech, capital-intensive manufacturing industry into the country. And it has succeeded, with the iPhone, with some of this electronics. But actually all the other, the rest of the manufacturing industry hasn't really got there. And why is that? I think a lot of it has to do with how the country remains quite protectionist. So, when you are in the world of manufacturing these days, you cannot be a standalone. And you are trying to grow when there is already China there. And China is now basically just the factory of the world. And the factory of the world is still much more efficient than everybody else. So you cannot really capture all the upstream and downstream into another country without paying more, right? So okay, people are paying more to be in India, but then they still need to import a lot of the upstream products. And the tariff has gone up over the years in India. So it's not easy. So it makes it more difficult actually to get all these parts if you want to actually assemble things in India. So that part, I think they need to do a lot more to change that picture, because otherwise it will just be more services driven. And I mean, this is a country where per capita income is still $2,500 US. I mean, this is China in, I think, before the global financial crisis. And then since then, it was all, trade and housing. But then China grew also because it has a lot of savings. And India, India is a typical emerging market where it actually needs foreign financing. It doesn't have enough domestic savings. So I think the story is quite different. Of course, it has a standalone, it's growing really fast because of the demographic. But I think the pool in terms of, influencing other countries, importing a lot of commodities, it's not there yet.
Great. So it has potential, but still a long way to
yes,
go.
potential has a long way. A lot of people got excited about the stock market. But then I think a lot of that has to also do with the domestic market, where people have just moved into the stock market because now they can use their cell phone to invest. Mm-hmm. So this is a little bit structural also in that sense.
Okay, great. Before moving forward, I got two questions about China. I told you China is the main focus here. The first one is, if China really slows down, I think if go to a hard landing, what are the impacts in emerging market economies?
Yeah, so I mean, so you can think about a very bad scenario next year, where a tariff from Trump might be there, might be very high. He talked about 60%, but 60% is basically you have to take China out of this most favored nation group, which basically China will be with North Korea, Cuba, and the like. And so this is very extreme. But I mean, I think in that scenario, you could really get growth slowing down to more like 2-3%. But then I think they will respond. I mean, that will actually really force them to respond with a big fiscal boost, which basically will absorb some of that losses. But for the other emerging markets, which depend on the commodity producers, I think it will basically, this will show up on the commodity prices. And for the other manufacturing-based type of economies, like in Asia, that might not be so bad because there might be some diversion into those countries, like Vietnam, Thailand, Malaysia. But for the commodity-producing countries, it might be a bit difficult.
And the second question is also about China. So the client is asking if the current measures will be enough to keep up the GDP growth and avoid a reduction in consumption and GDP, and also what are the risks of a steep fall in iron ore prices and also oil prices?
So on the
The first on the measures, will
On the
be
measures,
the enough, or we need to see more?
Yeah, the measures are not enough, in my view. These measures basically just give you more credit availability, but you need to have people to actually want to borrow. And the households are not borrowing because the housing market is not looking, still doesn't, and it hasn't reached bottom yet. So you're not going to jump and then trying to, buy more houses. Then you have the corporates, and the corporates that are basically the ones that, that need actually financing usually don't get financing. The ones that are getting the financing are the ones that are in the strategic priority, and they already get a lot of financing. So if you fall in between, then this private investment in other sectors, I don't think you are going to try to get more credit because you don't see that it's going to improve much.
And the second part of the question is about risks of commodity prices going much lower, and specifically the iron ore and oil prices. So.
Yeah, I think on oil prices, it's not really, China is not really the main mover in the oil market. So it might have a little bit of an effect, but I don't think it's going to be like, the one that really drives the oil market. It's usually more on the US and also more, other countries on the global economy. On iron ore, there is a possibility. It has already come down quite a lot, right? The iron ore prices. But if you think about, how all the steel mills in China are really struggling, and if we think that there will be more tariff from other countries that to put basically in EMs to stop this steel exports from China to enter their countries, then then the steel mills will probably just need to be shut down. And if they are really being shut down, then I think this iron ore price could fall further.
Okay, thank you. I want to take advantage of the fact that you look at all countries, and sometimes it's good for us to hear the foreigner perspective on our domestic economy. So, if you could share your view on Brazil, and in a broader perspective, all countries, we're just discussing about easing measures coming from China, Fed cutting rates, and Brazil is hiking. So what's your view? What did go wrong here in Brazil?
No, I think from the foreign investors' point of view, I think they have been actually surprised by how resilient growth has been here. I think every time, the GDP release came out, it's always exceeded, I think, most of the expectation from the foreigners. I think also probably from here too. And that has been going on for like 3 years. So, okay, as some of that is the supply side. You have much better agricultural production. You have more oil production. But also quite a bit of that, I think, is also comes down to the fiscal policy, which I think people were quite sanguine up until probably at the beginning of this year, when people started to think whether this is going to be whether a real consolidation will actually be coming, because people have been expecting that and hoping for that. Right? And I think now, it is playing out, and I think you see it more driven already from the locals, that the locals don't seem to believe that that this fiscal policy change is going to happen. And I think that is reflected also on the foreigner side. So foreigners are now a little bit more reluctant to go in, and then you can see this on the currency.
And if you remember last year, everybody was talking about Latin countries, so it was a good place to go, friendshoring. It's far away from the wars and all that. Commodity prices were high at the point, and also we had high rates. So maybe we'll get to higher rates again. But it also changed the LATAM scenario for the foreign investors, right?
Yeah, I think the LATAM scenarios last year was all about carry. So people are very happy, they park the money in Brazilian real, in Mexican peso, and that has been basically been the theme of the investment. But then I think this year it's all about the domestic stories that have driven these countries. I mean, Brazil, we talked about fiscal policy. In Mexico, you have seen how AMLO has been behaving since, the last few months after the election. And I think that has really kind of pushed the investors to stop and then, to think whether this is a good idea or not, even though rates are still high, and you can still get carry. Yeah. And I think for Mexico, if you think about it, there has been so many stories on this, benefit of friendshoring from the U.S. But if you actually look at the numbers in terms of the data, in terms of the foreign direct investment data, it actually hasn't really improved. It's been around this 35 billion US dollar per year, pretty much every year in the last 10 years. When you look at the latest few years, basically what it's showing is that most of the investment is actually reinvestment, and new investment is very small. It's like maybe 3 billion or something, which actually shows you that I think it's not an easy place to actually operate. And I think those who are already there, they can manage and they increase their investment. The new ones haven't really entered, even though there's a lot of talk of entering, because there's a lot of, I think, things that you have to think about structurally: security, infrastructure, power. So I think the story is good, and I think it will carry on, at least, unless Trump comes, which will be another story. But if Trump doesn't come, and it's still we get the Democrat, we are still going to be, I think, talking about this friendshoring story for Mexico. But then there are a little bit, in terms of the domestic story, they are kind of defeating themselves quite a bit.
Do you think the judicial reform will be the first one of many other measures that could be, could be bad for the investors, or it's just one-off and we still see the Mexico being it used to be the star of the emerging markets, right? So you had the US right away, the friendshoring, that never came in the numbers, I agree with you, but do you think they still have a good story ahead, or is just the beginning of a bad story?
Yeah, I think if you look at AMLO's list, which he came up in, I think, February this year, the list is quite long. So it's not only this judiciary. I think what people worry about is also many of these independent bodies, which he would like to abolish. So this could still come in the next few months. And since we haven't seen much protest or much, talk from the new president, so it's not very clear whether, she will actually oppose to any of this, which will make it actually quite difficult, I think, for Mexico.
Yeah, because in the beginning of his mandate, he had like the airport thing, and then it went all right. Better than everybody thought. So it was like, it starts with a bad thing, and then it gets better. But now, we don't know what she thinks, right? So she's being quite quiet. And so looking at emerging markets as a whole, we have like a good scenario coming from in the US to emerging markets. Who will benefit? Who is going to be the next star in emerging markets? It's Asia markets. Because Mexico, we're thinking about Mexico. Foreigners are like not understanding what is happening to Brazil. So who will benefit for that? Next year.
Yeah, I think a lot of the main beneficiaries will be in Asia. The smaller countries, basically, they have had already low inflation, already at the target since, let's say, the beginning of this year. They could have lowered their policy rates already, but they were waiting for the Fed, basically. So we already started to see, countries like Indonesia lowering their rates, We are starting to see also more, I think, investment going into many of the Southeast Asian countries, like in Malaysia for a lot of the semiconductors. So I think lower rates together with, this China +1 type of investment will help to drive many of these smaller Asian countries.
Okay, great. I have another question here. It's what do you hear the most from foreign investors about Brazil economy? Are they optimistic? And in comparison with the other countries in emerging markets, are we good in the picture?
Are we what?
Good in the picture.
No, I think if you ask fixed income investors who invest in the corporate papers, I think they like Brazil. I think the companies that issue in US dollars, they're quite solid, and I think they deliver pretty good returns. So I think that continues to be the case. If we talk about equity investors, there were some interest. I was just telling Daniel earlier that this is usually when the Fed cuts its rate, then you get weaker US dollars, and usually the weaker US dollars drive the emerging markets, equity markets, which the correlation is usually be pretty high for Brazil. But then, now we also have the situation where rates are also getting higher here, which basically make the locals switch back into fixed income, which might not benefit so much in terms of the equity market. So I think on the overall, it depends on where you are in the, on the asset allocation. But I think in terms of if you look at the growth prospects, I think Brazil within the region is still one of the best.
Great. And I have another question here asking about if Trump wins, how it would directly affect Brazil scenario.
So I think Brazil is a little bit more insulated in the sense that it doesn't get, the direct tariff right away. But then I think it's more indirectly through China, and that's how, and through commodities. And I think that's how it's going to be mostly impacted. And also because then the US itself, if let's say the Fed cuts until December, and then in January, Trump actually is inaugurated. And, if you are the Fed, you would be a little bit more hesitating to keep lowering the rates if you think that, this one-time price increase by the tariff hike is going to come. So then it would make, the Fed cut trajectory, I guess, flatter than what people have or markets are expecting right now, which is not really helping the world.
Mm-hmm. If Trump raises tariffs on China, then we would probably see a reaction in the yuan, right, the CNY, and this could also trigger depreciation of the BRL, you think?
I think the correlation hasn't, or at least in the last few years, hasn't been very high. I think it goes through more of on the commodity channel. So I think the CNY is more correlated with all the other Asian currencies, and those will probably go down. Yeah.
And we still have some time. I want to talk a little bit about Argentina. So there's always a promise that they will solve the problems, and I mean, there are a lot of problems over there. Do you look at Argentina? Are you seeing anything there that, I mean, do you think they have a good story that they can solve or have more optimistic view on the future?
No, I think since Milei came, basically, I think this has put basically Argentina into a different path now, because now he is back into this, stabilization program, right? Which they have been trying to do, but then, it never worked. So I think the fiscal shock, or, this shock therapy where he really consolidated the fiscal picture it's actually working. If you look in the last, I think, 8 months or so, I think almost every month he has managed to achieve a surplus on the fiscal book, which is quite remarkable if you think about all the other years before. So I think that's one good thing. But of course, if you correct your fiscal path so fast, then your economy is also going into a very deep recession. So we are talking about minus 4% or so for the year, which is very hard. But it's also corrected the inflation expectations and also how inflation has been moving. So I think now it's going around like 4% per month, which is already like much better than what it used to be. Right? So I think now the difficulty is that you have achieved this front-loaded fiscal program, but then you still want to get your inflation even lower. But how do you get it lower? Because if you don't get it much lower, there are also the currency is depreciating at 2% per month, and your inflation is still 4% per month, which means that your real currency, the real rate, is actually appreciating again, which makes you, let's say, I wouldn't say not competitive, because in the end their exports don't really depend so much on the currency, but then it makes, if you are an importer, you want to import again, and your correction on the external side is not going to happen, right? So I think this makes life very difficult now. So you have achieved, to a certain point, but then I think the next step is much harder, because I think the next step is that you need to correct the currency. But correcting the currency also involves taking out capital controls. And you need to have money to actually, you need to have dollars in your coffer to actually open up the capital account. And without that, I don't think they can actually manage to do it, because they are, with the real rates already appreciating again, they're already intervening again in the currency market, which means they are not collecting more reserves. So, there are a lot of I think, amortization is coming in 2025, which is not very far away, as at the end of the year. So they don't have that much time to actually collect more dollar to actually, to pay back the investors. So in the end, I think the scenario that I can see is that because, Milei is the only hope that the IMF could actually get their money back, so they'll lend them more to them. And there's no way around it, I think. So they'll get another program, and then they'll open up the capital account, adjust the currency, and then, be able to pay back hopefully at the end of 2025. So that's kind of the good scenario, I think.
Great. When I talk about, investments and the outlook for the future, everybody's talking about AI, right? So how do you think this new world will play out with emerging markets? My question is, because I look at Brazil and say, well, we are not there. I mean, we'll just be the commodity producer and export to China. I mean, where are the countries that will benefit from or are prepared to go in this new world with AI, technology and all that? So this new jump in productivity that we may see.
Yeah, I think unfortunately EMs are not really prepared to be the ones to benefit, at least at this point, from this AI movement. Because in the end, you need a lot of, I guess, the infrastructure in terms of the, internet speed. You don't even have to talk about productivity in terms of what you actually use for AI. I mean, there's a lot of easy things you can use for AIs that can replace, labor, or for replacing people, right? I mean, you can think about easy chatbots for call centers, things like that. But then I think beyond it, which is where productivity will actually increase, for EMs, I think we are not there yet.
And what about China? Because everybody says, well, in 30 years from now, China will surpass the US. If the US is the center of the innovation now in AI, it's hard to see that scenario, right?
Yeah, I mean, a lot of it is also that people don't really, I mean, there's so much of, this decoupling between China and the US that, okay, right now they don't really share any of this, the technology that they have developed. But if you look at China, the system and the what you can actually do with a lot of the apps is actually quite advanced. It's like much more advanced than what you get in the US. You can do everything in one go. You do include all the payments and all the investment. You can do everything from the phone, right? And also their technology in terms of, I think, the AI that has to do with, like the self-driving, for example. So they are leading in some sectors, which might not be shared, right? It might be shared more with, I think, EMs, because most EMs are kind of neutral between the two camps. So there might be some benefit, for EMs, where, if we think that this technology competition is going to continue, then EMs could benefit from this, but then you will have to, learn both sides of technologies, and it might not be the most efficient thing.
Great. We have 1 minute left. Can we talk a little bit about markets? I mean, do you have any, looking 12 months ahead, should we be in the stock market? Should we be in the fixed income? What do you guys see over there?
You mean for EMs or for outside of EMs?
For EMs.
No, I think for EMs, as I said earlier, weaker US dollars usually support EM equities. Of course, now we also have a lot of this domestic problems in different countries, like here, like in Mexico, and that has been basically driving down the asset prices. I mean, you see this in other emerging markets, like in Asia, like in also Central Eastern Europe. They also benefit quite a bit from this lower rates, the investment from the euro area. So I think, yeah, on the fixed income side, I mean, local duration is good. I think the correlation is clear. There's one-way direction that it's going, and this is basically, in pretty much in all the countries that are lowering rates, maybe except here.
Okay. Well, Mali, I want to thank you so much for the great conversation. It was great to hear from you. And I want to thank you all. Obrigado a todos. E até a próxima. Obrigado.
Thank you very much.
Alô? Pessoal, pediram para avisar para devolverem os